Let's just dive right in. We've got a pile of research here that really hits three of the biggest pressure points in global finance right now. We're talking about the Fed's rate cut, the massive corporate debt being fueled by the AI arms race, and this huge geopolitical challenge to the U.S. dollar.
That's the core tension, exactly. And our mission here is to drill down past the headlines. We're going to guide you through what actually happened and, connect the dots on why these things are all converging right now.
Right. So let's start with the central bank. The first source, ready for FOMC, it really focused on the Fed's favorite inflation gauge, the PCE.
Personal consumption expenditures.
It grew 0.2% month over month and 2.8% year over year.
And what's fascinating there is that while 2.8% is still, above the 2% target, the data is stable. It's sticky.
So it's not going up, but it's not really going down either.
Exactly. And that stability, along with other signals, is what drove market expectations for a rate cut to, over 82%.
But the real urgency, and this is highlighted in the real economy, is where the official government optimism just completely collides with the data on the ground.
Right.
I mean, forget GDP for a second. The data shows 40% of small companies are producing zero earnings. And bankruptcies, they're at a 15-year high.
Wow. And that's it. That's the real justification behind the push to lower rates. It's an urgent need to try and head off rising unemployment.
And the market knew it. The source FOMC Week pointed out that the 2-year Treasury was already yielding 3.58%. The cut was completely priced in.
And it also noted some really bizarre year-end performance. Gold was the #1 asset by returns, not DAC.
Yeah, and the NASDAQ was lagging behind EFE stocks. That's, Europe, Australasia, and the Far East. Pretty unusual.
Very unusual.
So the predictable move happened. The source, there is no risk-free path, confirms the FOMC announced the 25 basis point cut. New range, 3.50% to 3.75%.
But the guidance was, it was all over the place. The median expectation was just one more cut in 2026, but the projections ranged from 0 to 4 cuts.
That signals huge disagreement inside the Fed.
It signals extreme uncertainty. But the real story in that source isn't the cut itself, it's the new liquidity measure.
The RMP.
Yes, the reserve management purchases. $45 billion a month in T-bills. This is basically the Fed quietly stepping back in because they're worried about the plumbing of the banking system. It's a mini QE.
So the Fed is worried about internal stress. Let's zoom out from that and pivot to this massive systemic risk from the source, the infinite AI game. The AI race is this infinite game that demands just incredible amounts of capital. The source uses Oracle as an example, taking on huge debt to build data centers.
And creating this worrying mismatch between their revenue and their costs. And this debt concentration is a whole other risk layer we have to talk about.
How big is it?
AI-related investment-grade debt is now 15% of the entire corporate debt market. And it's expected to hit 20% in 5 years.
15%. Just to give you some context for that number, the auto industry, the one that needed that massive 2008 bailout, it only accounted for 8% of corporate debt at its peak.
It's a huge concentration. And this risk feeds directly into the two competing scenarios for the long end of the yield curve, from the Fed and the curve.
The 10-year Treasury, it's been stuck between 4% and 5%.
Great. So for 2026, the debate is simple. Scenario 1. AI productivity actually controls inflation, letting the government lock in lower rates.
Then scenario 2.
The market loses faith in the Fed's ability to control inflation, yields spike, and basically all assets have to be repriced. A whole different ballgame.
Okay, now let's turn to the biggest external threat, which is detailed in the source called the unit. We're talking about the BRICS nations.
And their silent revolution against dollar hegemony. They're developing a gold-backed settlement instrument. They're calling it the unit.
So it's not a new currency then?
No, not a full currency. Think of it more as a collateralized trading instrument. It's designed to reduce their reliance on the dollar and, the SWIFT system.
And it's backed by gold.
40% gold, pegged to a fixed weight. And it's backed by over 5,000 tons of their collective reserves. The other 60% is a basket of their own currencies.
The implication is pretty obvious.
It is. BRICS central banks are actively buying gold. And if this initiative is successful, it could signal a new world order.
So let's tie this all together for you. The Fed is easing, right? They're forced to by this rising distress in small businesses and these liquidity concerns in the banks. They're looking inward.
But at the same time, you have these two massive long-term risks just accelerating. One is the AI debt concentration at home. The other is this huge global effort to challenge the dollar.
The tension is undeniable. The U.S. is juggling yields and bank plumbing while the rest of the world is sort of getting ready to change the locks on the global financial system.
Well said.